I covered over 130 companies overall in 2024. Many of them were really great companies that I recommended investors buy, and few of them, were really bad companies that I warned investors to avoid. This is what that video is going to be about. I'm going to talk about the disasters of 2024, stocks that I warned investors about, and the outcome of those investments for investors that chose to stick with those investments. I'm going to share with you the 5 companies that I had rated as a sell in 2024, how they performed in 2024, why I have them rated as a sell, and if I have them still rated poorly for 2025. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So out of all of the companies that I followed over 130 in 2024, and by the way, I do have a spreadsheet where I keep track of all of the stocks that I cover and my ratings on the stocks, and I provide updates, and I don't avoid stocks that I might recommend as a sell, but then they improve. I also don't avoid reporting on stocks that I have rated as a buy and they perform poorly. One example is Intel, which I have had rated as a buy all year long in 2024, and the stock price underperformed significantly, was down big in 2024. But I still reported on it and I still gave information on Intel. I don't avoid stocks that I misrate or give a rating that's not what is the right outcome. But these 5 stocks include Nikola, Chegg, Fubo TV, Plug Power, and ChargePoint Holdings. I had all of these stocks rated as a sell in 2024. In fact, Chegg I had rated as my top stock to sell, the one that I told investors to avoid most prominently. And all 5 of the stocks that I had rated as a sell were down significantly in 2024. So those were incredible results, batting 1,000 on my sell ratings in 2024. Some of these were incredible disasters, including Nikola, which is down over 95% in 2024. I've actually had Nikola stock rated as a sell for several years now, and it was down over 95%. Chegg, the stock I had rated as the top stock to sell, was down over 85% in 2024. Chegg, man, the story around Chegg is amazing. I believe Chegg was my top stock to buy in 2020 or 2021. And it fell from my category of being rated as one of the top stocks to buy all the way down to being the top stock to sell. I've never experienced a dramatic fall like I've experienced with Chegg in all of my years of investing. And you might say, how did that happen? Well, you can blame ChatGPT. ChatGPT and large language models really crushed everything that Chegg was as a business. It really crushed the business model. And I don't know, and I couldn't think of a way that Chegg can counter what ChatGPT did to its business. And so I had no choice but to tell investors this business is in huge trouble. And I warned investors at the start of 2024 that this was one that you wanted to avoid because I don't know how it can survive as a business anywhere near the level it was operating at before the launch of these large language models. If you're wondering why, Chegg helps college students with their studies, and Chegg had this database where students could go and look up questions and answers to problems that they might have in their university studies. And Chegg would have step by step solutions for some of the problems that students experience in their day to day studies. Additionally, as part of your membership to Chegg, students could ask 20 questions every month that were answered by Chegg subject matter experts. This is what Chegg students were paying for every month, between $15 a month and $20 a month. Well, now with ChatGPT, why would you pay $20 a month to Chegg when you can get these answers on ChatGPT or on Google Gemini or another large language model for free? And these answers, in my experience, are either equal to or better than the Chegg website because of how the answers are organized and delivered. And so I saw this firsthand on campus. If you don't already know, I'm a university professor. And when I was walking through campus and looking at, glancing at student screens, what they have on their laptops, or in the computer lab, what websites they have open, I stopped seeing Chegg on any student computer screens, whereas I used to see them all the time. And I saw ChatGPT open most of the time when they were on the computer studying. So this business, I'm not confident about its prospects longer term. I still have it rated as a sell, even going into 2025. The others, Fubo TV, Plug Power, ChargePoint, these were businesses. And let me share with you the cash flow. Here's the cash flow from operations on a trailing 12-month basis for these businesses that I rated as a sell. Interestingly enough, Chegg is the only one that had a positive free cash flow in this list that I rated as a sell. The rest were losing significant sums of money on the bottom line with little improvement in the business. You could see here Plug Power losing 840 million on a trailing 12-month period, and the losses are decreasing. But this isn't because the business is improving. This is because they just started to stop going for growth and just try and shrinking the business. And so, as part of shrinking the business, they're also shrinking the losses on cash flow from operations. This wasn't due to the reason why I like to see companies' losses reducing is because as they're growing their business, those increases in scale are reducing cost per unit and thereby improving the business model. That's not what's happening at any of these companies, save maybe for Fubo TV, that is demonstrating that kind of improvement. The company increased prices, and I think there's a lot more price increases that they need to do, but I don't like Fubo TV's prospects because they need to pay the content owners for the content on the platform, and the price that they have to pay for the content exceeds the price that they can earn in the course of doing business. And so I've been talking about how Fubo TV needs to raise prices significantly in order to better balance the business. But if they do that, they run the risk of losing a lot of their subscribers that they gained. Furthermore, the major streaming providers are now embracing sports. As you saw, Netflix with the Christmas Day NFL games, Disney announcing that it will bring ESPN to a streaming only subscription, and others as well. So you're finding more sports on various streaming channels, and so you don't need to have that streaming bundle that Fubo TV provides as a sports-centric model. So, and then Plug Power, I already talked about the losses. ChargePoint, uh, electric vehicle sales are nowhere near where ChargePoint was hoping they would be at this point. And electric vehicle sales are one point of evidence. If you look at Germany, when Germany removed the subsidies for electric vehicles, sales fell by roughly 20% year over year. So the organic demand for electric vehicles is very, very low. It's very, very low. Governments are trying to get this industry going by putting out trillions of dollars of benefits and incentives to companies to try and get this industry growing. But the demand from customers and consumers is just not that great outside of China. In China, demand for electric vehicles is actually strong. Everywhere outside of China, demand is weak. So these are 5 companies that I have rated as a sell. And yes, I still have them rated as a sell going into 2025. I have one additional stock that I have rated as a sell for 2025. That's for another video. I'm not going to talk about that one. I just recently downgraded it to a sell, and I did a video about that stock. And if you follow my channel, you probably know what that stock is. So hopefully you followed my recommendations to avoid these stocks and you avoided these disasters in 2024. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.